more seconds to go. And the decision is out. And as expected, we got a 50 basis point hike to 3%. What a result there. Let's cross over to Josh Mahoney now for the analysis on our charts.
Yeah, thanks a lot. Look, I mean, this has been a topsy-turvy week, to say the least. What started off as a crisis in the US banking sector has shifted towards the EU. And certainly that fear around Credit Suisse at the moment does really put pressure on the ECB. Were they going to bow to pressure and start to limit the amount that they were going to raise rates by? It doesn't appear to be the case. And certainly that is notable. It is a nod to the likes of the Federal Reserve. Let me show you euro dollar and exactly how we are playing out at the moment. We can see that the decline coming into the announcement is now starting to reverse. I think if you look at this over the course of the week, we can see this is the period where we thought that everything was mainly US centric, and therefore it was likely that we were going to see the Federal Reserve hike by a lower rate than some had expected. And then this is when we suddenly started to think, well, actually, everything that's happening over in at Credit Suisse means that we could see the same kind of thing from the ECB. Well, the ECB have not bowed to that pressure. They have hiked by 50 basis points. And this really throws it back to the Federal Reserve. Are they going to follow suit, or are we going to see them actually limit the amount that they're going to raise rates by? So if that was the case, we could see further upside, much like we saw earlier on in the week. There's going to be a big focus on expectations in terms of growth, in terms of inflation, people trying to gauge exactly where the terminal rate is. But by and large, you know, markets had started to temper those expectations for a 50 basis point hike over the past 24-hour period. And I think by and large, we don't really have much more upside in terms of interest rates. So there's going to be a big focus on the commentary that comes out around this meeting and exactly how high interest rates are going to go, considering the fact that we have seen this oversized move.
Now, of course, the ECB also coming out with its inflation expectation stuff. They're expecting inflation averaging 5.3% in 2023, 2.9% in 2024, and 2.1% in 2025. So clearly, they are expecting to have inflation come down. But what is interesting is, despite the SVB, despite the Signature Bank and Credit Suisse as well, we have seen the ECB sticking to this rate hike. And just to recap for you, the rate on deposit facility now at 3% versus 2.5%. And they also raised their interest rate on marginal lending facility to 3 3/4 from 3.25%. So we're also seeing oil continue to come off the 15-month low, and as you said, the euro dollar cross as well. The euro improving as we speak there. What else are you looking out for, Josh? What else should investors be looking out for other than comments from policymakers?
Okay, well, aside from that, first and foremost, I want to give you my main takeaway from this. And that is that much of this crisis in terms of the banking sector has been set about after a period of interest rates being pretty much at zero and people taking on specific positions. Now they've all switched because we've seen this massive hike in terms of interest rates. That's what's got us into this mess to a large degree. The idea is that if you wanted to reverse all of that and the losses that many of these banks have got on their books, you need to just cut interest rates, right? And so what we have here is the continued push higher in terms of interest rates, the continued pressure on that sector, and no sign that they're going to reverse or pivot that viewpoint. So we still have the problems in terms of the banking sector, and we see the oversized hike in terms of interest rates, both of which are negative for equity markets. And we can see exactly that now. The DAX heading lower once again. We can see heading back down towards the lows of yesterday. The 4-hour chart showing you exactly that. The rebound that did take shape coming into today's session just did not hold, and we've really dropped quite significantly back down into the prior low. So unfortunately, the idea that, you know, what's happened in terms of the Swiss National Bank has propped things up and everything's going to be hunky-dory, that doesn't necessarily hold true at the moment. And what the ECB have done is certainly not necessarily supportive of the sector as a whole, considering the trouble that some of those banks are in. So this, to me, points towards further downside over the near term. Certainly that wider view does highlight the perspective that we're looking at. The fact that we've taken out support in the 151.44 and the 149.03 points towards us likely retracing this rebound here. So I think there's a good chance we can drop down towards your 144.63, maybe even your 141.70s. But certainly with the fact that we're now breaking through yesterday's low and creating a fresh 2-month low, I think there's further downside to come here for European equities.
All right, thank you very much. IG's Josh Mahoney there talking about the ECB and how they are for now setting aside those worries about the banking coming out from the banking industry and instead sticking to its pledge for the timely return of inflation to the 2% medium-term target. And as expected, the ECB has increased the rate by 50 basis points in line with this pledge to bring inflation back to that 2% target.